Hi, my name is Elliott Gue and I'm the editor of the Energy Strategist. I wanted to talk this week again about the weekly oil inventory report. Tomorrow, of course, will be the natural gas report, so I'll also have a webcast up tomorrow about that. For those of you who have been watching me the last several weeks on a weekly basis, I apologize for not being back last week. I was actually in Tucson, Arizona, giving a presentation at a little conference out there. But this week we actually saw somewhat of a shift in the oil inventory report and in the gasoline inventory report. For those of you that have been watching it, you know that oil inventories have basically been rising faster than expected for most of the last 10 weeks. I think with the exception of this week, about 7 out of the last 10 weeks, oil inventories have actually built or risen faster than had been expected prior to the report. Oil inventories are about average for this time of year, just a little bit, just a touch above average for this time of year, above the 5-year average. But they certainly are looking a lot healthier than they were towards the end of 2007, when oil inventories were drawing down during a time of year when they typically rise. The oil market has not really responded to this. That would typically be seen as a rather bearish development for oil. The oil market hasn't responded to that mainly because of the U.S. dollar. What we've seen is that the U.S. dollar has been selling off to new lows against the euro and the yen. If you look at the price of oil in yen or euro terms, it's actually flat to slightly lower for this for the year since the end of 2007. So the rally that we've seen in crude oil, we certainly have seen a rally in crude oil in dollar terms, but it really hasn't been based much on the fundamentals, which show that oil inventories are healthy. We actually also saw in today's report that it looks like oil and gasoline demand is off a little bit here in the United States versus what it was 1 year ago. Most likely that's a function of higher prices. Gasoline. Gasoline is the other market that I've been watching very carefully, also released as part of today's report. Gasoline inventories have been rising way above the 5-year range for the last several weeks, building a lot faster than had been expected. We have very bloated inventories of gasoline in the United States right now. Typically, again, that would tend to put downward pressure on gasoline prices and on oil prices. However, of course, gasoline prices have been rising as well, along with oil, being sort of pulled higher by oil. However, this week, for the first time in about 6 or 7 weeks, we actually saw inventories of gasoline draw down, and they drew down a lot more than had been expected. So we are starting to see those gasoline inventories come back down a little bit, though they're still very elevated for this time of year. Today we actually saw crude oil sell off a little bit, and the main reason for that, I think, is that a combination of really two things. One is a little bit of profit taking, and maybe just the beginnings of traders taking a more careful look at oil fundamentals rather than just oil as a currency trade. Another area that I'll be watching very carefully over the next several weeks, in fact today's issue of the Energy Strategist, my paid publication, I talked a lot about this sector, which is the refining area. Refining margins have been very low lately. We've been under $10 in terms of the crack spread, which is basically the best measure out there, quick and dirty measure of profitability for the refiners. Usually during this time of year we actually see crack spreads widen, in other words profitability for the refiners increase. Hasn't happened this year. Main reason is rising prices of oil. Oil is a key cost for the refiners, and oil prices have been rising faster than gasoline prices. Part of that, of course, is due to those extremely bloated inventory levels for gasoline in the United States. Crack spreads are very low. I do expect some sort of a spike in crack spreads sometime over the next month and a half. So I wouldn't necessarily give up on the group just yet. A lot of them are very cheap by historical terms. But I'm getting a little bit more worried about the refiners as we step off into the summer. Crack spreads haven't risen much this year at all. And so I do think we might actually see a pretty weak year for the refiners overall. So that'll be a group that I'm looking to play over the next month and a half, but not really much past the beginning of summer. Once again, I do want to mention that the market that I'm much more excited about than oil or the refiners is natural gas and some of the natural gas exploration production companies. We get natural gas inventories tomorrow. Last week we saw gas inventories draw down more than expected. I would not be surprised at all if by the end of this heating season we actually see gas inventories under the 5-year average, and we could see a real spike in gas as a result. By the way, gas prices are up a lot more than oil this year, and really on a currency-adjusted basis, they're still up. So I think that's a much more promising market, and I'll be back tomorrow morning with a webcast on that. Thank you.